Namaskar, welcome to Kalam IAS. This is Vasudev Singh Bhati, and today is the second session of the banking, and we have done some topics in the banking, and today we are going to do the topics which were left out in the previous session. So in the banking, the first thing that you should know about is the banking structure of India. We did not talk about it in the last class, so we will talk about it in this class. That what is the banking structure of India. Now in banking structure, first is there are several types of banks. The first is commercial banks. Commercial banks are basically banks exist for the purpose of commercial benefits. Okay, so there are 6 types of commercial bank. First is domestic sector private banks. For example, ICICI Bank, HDFC Bank, these are all domestic sector private banks. Then we have domestic sector public banks. For example, State Bank of India or Punjab National Bank. These are also commercial banks. They exist for the purpose of apart from the public service, they also exist for the purpose of profit making, and these banks book profit, so they are commercial banks. So domestic public sector banks are also commercial banks. Then there are foreign banks. Citibank is a foreign bank. Then there are regional rural banks, RRBs. Then there is payments bank, and finally small finance bank. So these are the 6 types of commercial banks existing in India. Next is cooperative banks. Cooperative banks are basically banks which are owned by the members, or which are owned and operated by the members of the cooperative society. So cooperative banks do not exist purely for the purpose of commercial purposes, or for the purpose of making profit. The cooperative banks exist for ensuring that the members get credit on low rate. So first is UCB, that is urban cooperative banks. Then there are state cooperative banks, for example, primary agriculture societies, primary credit and agriculture societies, PACs. And so similarly, there are several cooperative banks. Then there is development bank. Development bank is basically banks existing for the development of particular industry or particular sector. For example, SIDBI. Now this is a small industry development bank of India. SIDBI focuses on development of small industries. Then there is Mudra Bank, National Housing Bank. National Housing Bank basically focus upon development of the housing finance sector, and ensures that the housing finance is in streamlined with the economy of the country. So there are several types of bank. So the biggest and the most important obviously is the commercial bank sector, in which there are domestic banks, there are public sector as well as private sector bank, there is foreign banks. Then there are differentiated banks also. For example, payments bank and small finance bank, these two are differentiated banks. They provide specific services. For example, payment banks cannot provide credit. The payments bank provide remittance services. Small finance bank can provide credit, but the terms and condition of their credit are different from other commercial banks. For example, small finance banks have to ensure that 50% of their loans are below 25 lakh rupees. So there are several limitations on small finance bank and payments bank. Other the domestic private banks and domestic public sector banks, they can function without any limitations. For example, they do not have limitation apart from the priority sector lending. Now, and there are banks which we call scheduled bank. Now we know which of them are commercial bank, and most of their commercial banks are scheduled also. Scheduled banks are basically which are scheduled under the Schedule 2 of, or registered under the Schedule 2 of Reserve Bank of India, RBI Act 1934, not Payment and Settlement Act, or any other banking regulation act. So people get confused between RBI Act and Banking Regulation Act. So you have to ensure that the scheduled banks are basically the banks which are registered under Schedule 2 of RBI Act 1934. And the paid up capital of scheduled bank is rupees 5 lakh rupees or more. It should be rupees 5 lakh or more. So these are the two conditions of scheduled bank. So most of the banks, almost 99% of the banks, commercial banks, are scheduled commercial banks, except some land development banks, local area banks. There are some local area banks which are not scheduled banks. Apart from that, all the banks in India are scheduled banks. Okay. Next is PCA framework. So when the banks are not performing well, when the banks face some financial stresses, to ensure that the banks come out of those financial stresses, and to ensure that the financial stresses of a particular bank do not impact the all economy or the whole economy, for that purpose, Reserve Bank of India has framed PCA framework, Prompt Corrective Action Framework. Now, what is prompt corrective action framework? It is basically a supervision intervention. It is a supervisory intervention where the RBI intervenes in the regular functions of the bank when the banks are facing certain financial stresses. Okay. So, which banks are the ones on which it is applicable? It is applicable to scheduled commercial banks. All the scheduled commercial banks, it is applicable except certain types of scheduled commercial banks. So it is not applicable to small finance banks. So we have seen small finance bank is a scheduled commercial bank, but on the small finance bank, the PCA framework is not applicable. Payment banks also, the payments bank do not come under the PCA framework. Then we have cooperative banks. So cooperative banks also do not come under PCA framework. Then there is, urban cooperative banks. Urban cooperative banks, they also do not come under PCA framework. Then regional rural banks. Regional rural banks come under the PCA framework of NABARD. They do not come under the PCA framework of RBI. So PCA framework, there are two organizations which implement PCA framework. Primarily it is of RBI only, but for regional rural banks, RRBs, for regional rural banks, NABARD has a separate PCA framework. Okay. So these are applicable to scheduled commercial banks except regional rural banks, payment banks and cooperative banks. Regional rural banks, payment banks and small finance bank. So we have seen this, there are 6 categories of scheduled commercial banks. There is public sector, the public sector domestic banks, private sector domestic banks, then there is foreign banks, then there are regional rural banks, small finance bank and payments bank. So the lower 3, small finance bank, payment bank and regional rural banks, on all these 3, the PCA framework is not applicable. About the upper 3, the PCA framework is applicable. And apart from that, NBFCs also do not have PCA framework applicable on them. NBFCs have a separate, separate policies for which RBI has formulated separate policies for NBFCs. NABARD has separate PCA for regional rural banks. Now, PCA framework. So, what are the things which are included in PCA framework? So it is to ensure that the banks with financial matrices are put under PCA framework and enables the timely intervention. It was introduced in 2002. So we have a UPSC PYQ where the statement says that the PCA framework was introduced in 2016. That statement is a wrong statement because PCA framework was introduced in 2002 and it has recently been extended to government-owned NBFCs. The PCA framework has been extended to government on NBFCs. So earlier the PCA framework was not applicable to NBFCs, but now it is applicable to NBFCs, and in from October 2024, it will be extended to the government on NBFCs. The government on NBFCs will come under the PCA framework of the Reserve Bank of India Act from October 2024. This policy change was made by the Reserve Bank of India in October 2023 and they gave a 1 year's grace period, and after 1 year, that is October 2024, the PCA framework will be applicable to government-owned NBFCs. All the NBFCs which are owned by Government of India or the state governments, they will come under PCA framework. So what are the trigger points for PCA framework? When does actually or exactly a bank will fall under the PCA framework? What are the criteria for that and how does RBI identify it? So RBI has certain objective criteria. ऐसा नहीं है कि उनको लग रहा है कि नहीं ये बैंक ठीक काम नहीं कर रहा है तो इसको PCA फ्रेमवर्क के अंदर डाल दो. तो उनके कुछ ऑब्जेक्टिव क्राइटेरियाज हैं. ऑब्जेक्टिव क्राइटेरियाज क्या है? फर्स्ट है कैपिटल टू रिस्क वेटेड असेट्स रेशियो. कैपिटल, आई एम सॉरी, आई एम हैविंग सम थ्रॉट प्रॉब्लम्स. So, first is capital to risk weighted asset ratio. So, capital to risk weighted asset ratio is basically capital upon risk weighted assets. So, the every bank has to have certain amount of capital. For example, if I have 10 rupees and I start lending money to people. So, bank function 2 types of things. First, they will take deposit and then they will do the lending. So, what I can do what I can do is I can take the I can have 10 rupees of my own, and I take deposit of 40 rupees and I lend 50 rupees in the market. So I have only for 10 rupees of my own, and I take 40 rupees from the people and I lend 50 rupees in the market. So that way my capital to risk weighted asset ratio, the money that I have lent to the people, that is 50 rupees, is risk weighted asset, and my own capital is 10 rupees. So capital to risk weighted asset ratio is 20%. So it is still a good bank. So the Reserve Bank of India says if the capital to risk weighted asset ratio falls below 9%, then that bank can come under the PCA framework. So first is capital to risk weighted asset ratio. Second is non-performing assets. Non-performing assets are basically the loans which which have failed to repay at least they have failed to repay the principal or the interest for more than 90 days, then they fall under the non-performing asset category. If I have lent 100 rupees and more than 10 rupees are due for more than 90 days, then those assets will fall under the NPA. And if the NPAs are more than 10% of my all the assets, then the bank will fall under the PCA framework. And the third is return on assets. If the return on assets is less than 0.25%, so capital to risk weighted asset ratio less than 9%, capital to risk weighted asset ratio, the higher it is, the safer is the investment in that bank. Return on asset, obviously return should be as high as it is possible. So return on asset, higher it is, the better it is for the bank. And the non-performing assets, the lower they are, the better it is for the bank. So if the non-performing assets are above 10%, then PCA framework will kick in. Capital to risk weighted asset ratio, if it is less than 9%, then the NPA PCA framework will kick in. And if return on asset is less than 0.25%, then also PCA framework will kick in. So these are the three criteria. So what are the actions that the RBI can take under PCA framework? There are several actions. There is a huge list which RBI can do. If the UPSC asks any question, then RBI can do almost anything under the PCA framework. It can merge a bank, it can split a bank, it can change the MD, CEO, it can ask the bank to not pay any salary to the top level employees, it can ask bank to not open any more branches, it can freeze its funds. RBI can do almost anything under the PCA framework to any bank. So some of the example are restricted expansion. For example, any a bank coming under the PCA framework, RBI can say that you cannot expand anymore, you cannot open new branches. The RBI can also ask them to skip dividend payments. So RBI can say, okay, you have depositors' money and your money is at risk, you are not performing well, your NPAs are high, your capital to risk weighted asset ratio is very low, so you cannot pay dividend to the owners. There can be recapitalization order also. For example, RBI can say any government owned public sector banks, for example SBI or Punjab National Bank, RBI can say that they need to be recapitalized and government should give money to them. And they can also ask for change in ownership. For example, if there is any public sector bank or even the private sector bank, the RBI can say, okay, you are not fit to run the bank and you should sell your shares to this particular organization, or there should be change in ownership to ensure that the bank runs smoothly. So RBI can do almost anything under the PCA framework. I don't think there is anything off limit in the PCA framework. There is a huge list. These are 4 examples that I have given here. You don't have to memorize or ratify anything. Just use your logic. If it justifies that, okay, it will help in ensuring that the bank runs smoothly, then RBI can do that. Next is non-banking financial companies. So we know about banking companies, banking organizations. So there are different types of banking organizations registered under RBI Act, Schedule 2 of the RBI Act 1934. Then there are organizations which are non-banking financial companies. So non-banking financial company is basically a company registered under Companies Act 1956. NBFC is a company, so it is not a bank, it is a company. It is registered under Companies Act 1956 and it is engaged in business of loans and advances like a bank. For example, a bank takes deposit and gives loans and advances. Similarly, an NBFC engages in a business of loans and advances. It can be deposit taking NBFC, it can also be non-deposit taking NBFC. NBFC can use loan, take loan from other and then lend it further. NBFCs can do that also. NBFCs can lend their own money also. If, for example, if I start lending people money and I form a company under Companies Act 1956, and I engage in the business of lending my own money, it is my own money, I have not taken deposits from the people, then also I can call it a non-banking financial company. It's a financial company, but it is not a bank. I am engaged in the financial transactions, but I am not actually a bank. So NBFCs are basically companies registered under Companies Act 1956, and they are engaged in the business of loans and advances. They can also be engaged in acquisition of shares, securities, debentures, bonds, any type of securities for that matter. And they can also engage in the business of leasing, hiring, insurance organizations, or chit fund organizations. They can engage in these businesses also, but they cannot engage. First is in agriculture, second is in manufacturing or industry, and third is in construction or real estate, or hiring and leasing or lending any property, any fixed property. So they cannot engage in agriculture, industry, and real estate. They cannot engage in any agriculture, manufacturing, and real estate. Apart from that, they can engage in all the financial intermediary businesses. They can engage in financial intermediary businesses where they are doing the business of taking the deposits, or just lending the money, or providing services like opening up securities account. I will buy securities, I will sell securities, I will lease, hire. All these transactions they can do. So these are basically non-banking financial companies. So examples of non-banking financial company, for example, NBFC MFI. So microfinance industry is basically a non-banking financial company. So there are NBFC MFIs. Then there are housing finance companies. They will provide loans specifically for the purpose of housing finance. Then there are government-owned NBFCs. So all these are example of non-banking financial companies. So what is exactly the difference between a bank and a NBFC? First is, of course, NBFC is registered under Companies Act 1956, whereas the bank is registered under Schedule 2 of Banking, Reserve Bank of India Act, RBI Act 1934. So first is, of course, it is registered under Schedule 2 of RBI Act 1934, and NBFC is registered under Companies Act 1956. Bank is not registered under Companies Act, and NBFCs are not registered under RBI Act. Okay, bank can accept demand deposits. Bank can accept demand deposits. NBFCs cannot accept demand deposits. There are deposit taking NBFCs, but they cannot accept demand deposits. Demand deposits are basically, if I make a deposit in a bank or any financial intermediary, I have right to demand or withdraw all the money whenever I want. Those are demand deposits. But there are different types of deposits. For example, if I am making a fixed deposit, now that I can do in NBFC. But demand deposit I cannot do in NBFC, I can do in bank only. So bank can accept demand deposit, NBFC cannot accept demand deposit. Other is, bank is part of payment and settlement system. Bank is part of payment and settlement system. NBFC is not part of payment and settlement system. NBFC cannot draw a check drawn on itself. NBFC cannot issue a check drawn on itself, whereas the bank can issue a check drawn on itself. Bank can say, this is this is the amount that the loan that I'm giving to you, and that is basically a check drawn issued by the bank, that is drawn on itself. Whereas NBFC cannot do that, because NBFC is not part of payment and settlement system of India. Third and most important is, deposit insurance is available up to 5 lakh rupees in a bank. If you deposit any of your money in a bank up to 5 lakh rupees, it is insured by the Deposit Insurance and Credit Guarantee Corporation of India, Deposit Insurance Corporation of India, and deposit insurance is not available under NBFC. It is not available under NBFC. So recently, the RBI has classified NBFCs into 4 tiers. RBI has said there are 4 types of NBFC. The first is base layer. The first type of NBFC is base layer. Base layer NBFC is basically non-deposit taking NBFC, which have a turnover of less than asset size of less than 1000 crore rupees. Non-deposit taking NBFC which has asset size of less than 1000 crore rupees. Whereas the next level is middle layer. Middle layer is basically non-deposit taking NBFC having asset size more than 1000 crore rupees or any other deposit taking NBFC. So in the base layer, there cannot be deposit taking NBFC. It can be only non-deposit taking NBFC, and their asset size should be less than 1000 crore. If the non-deposit taking NBFC asset size is more than 1000 crore, it will automatically come into middle layer. Or if there is any NBFC which is deposit taking NBFC, then that will also come into middle layer, that cannot be in the base layer. So base layer has two conditions: non-deposit taking, and other is less than 1000 crore rupees asset. If any NBFC does not satisfy any one of these criteria, if it has assets more than 1000 crore, it will become a middle layer company. Or if it is a deposit taking NBFC, it will also become a middle layer company. Then there is upper layer company. Upper layer company is basically 25 to 30, top 25 to 30 NBFCs of the country will always be kept in the upper layer of the NBFC, and top 10 will always be there. Top 10 will always be there in the upper layer. From 10 to 30, it is the discretion of the RBI whether to classify any particular NBFC into upper layer or not. So most of the NBFCs will fall under the middle layer. Most of the NBFCs, especially deposit taking NBFC, will fall in the middle layer. Top 10 for sure will fall into the upper layer, and if there are any more important, which are systematically important NBFCs, they can also be included. For example, the number can be increased to 15, 20, 25, 30, whatever the RBI sees fits, can be increased up to there, and those systematically important deposit taking NBFCs can also be included in the upper layer. Then there is top layer. Top layer is basically, in usual times, it will be kept empty. The top layer usually will be kept empty. It will only include NBFCs if there is any, if it is posing any systematic risk. If it is posing any systematic risk, for example, IFSL. So IFSL became a systematically important NBFC, and it posed systematic risk to all the financial sector in our country. And that is why it, after the IFSL crisis only, RBI came up with this 4-tier classification of NBFC. 4-tier classification of NBFC. The upper layer will remain empty usually. It will include only those NBFCs which have become systematically important and are at the risk of harming the country's economy. Only those NBFCs will be included here. Ideally, in usual time, it will be kept empty. Okay, so these were the 4 classification of NBFC. Now, there is a PCA framework for NBFC also. RBI has come up with PCA framework for NBFCs also. Now, on which NBFCs will it be applicable? It will be applicable to all deposit taking NBFCs. If there is any deposit taking NBFC, it will automatically, a PCA framework will be applicable to that NBFC. And if there is any non-deposit taking NBFC and it falls under mid, upper or top layer, not in the base layer, mid, upper and top layer, the upper 3 layer, it will fall under the PCA framework of NBFC by Reserve Bank of India. Then it includes government NBFCs. RBI has extended the PCA framework for NBFCs to the government NBFCs, so it includes government NBFCs, and it does not include NBFCs not accepting public funds. If there is any deposit taking NBFC, but it is not taking deposits from the people, it is taking deposits from the institutions, for example, financial institutions, then that deposit taking NBFC, NBFC is not accepting public funds, then that will not fall under the PCA for NBFC. That will not fall under the PCA framework for NBFC. It does not include housing finance companies and primary dealers, housing finance companies and primary dealers. HFCs, housing finance companies, are also not included. They are NBFCs, but they are not in, they will not fall under the PCA framework for NBFC. And primary dealers will also not fall under the PCA framework of NBFC. So earlier, the NBFC was not part of PCA framework of the Reserve Bank of India, but they have recently been brought under the PCA framework by the Reserve Bank of India. And what are the criteria for that? Earlier we have seen the 3 criteria for PCA were return on assets, non-performing assets, and capital to risk weighted asset ratio. So we see the capital to risk weighted asset ratio is here also. Here there is net NPA. In the PCA framework for banks, the RBI had criteria of gross NPA. Here the criteria is net NPA. So capital to risk weighted asset ratio is same there in both NBFC as well as banks. Then we have NPA criteria which is there. There it was gross NPA, here it is net NPA. And instead of return on assets, the third criteria here is tier 1 leverage ratio. Tier 1 leverage ratio. So these are the three criteria for PCA framework for NBFCs. Now RBI has certain new direction also. RBI has issued certain new direction also. For example, RBI direction on willful defaulters. So what are the applicability of RBI's direction on willful defaulters? Who are willful defaulters? Willful defaulters are basically willful defaulters. So who are willful defaulters? Willful defaulters are basically borrowers or guarantor. I can take money, or if I have guaranteed that this person will repay your money, then both of these person will fall under the borrower, willful defaulter category if they have defaulted without being constrained to do so. For example, if there is money that I need to pay to someone, I have the financial capability to pay that money, but I still refuse to repay that money, that I am a willful defaulter. It is not because of my own, bankruptcy. I have just refused to repay that money, then I become a willful defaulter. So borrower as well as guarantor who has defaulted without being constrained to do so, and the outstanding amount is rupees 25 lakh and above. If I have refused to repay just 5,000 rupees or 5 lakh rupees, then I will not be classified as willful defaulter. I will be classified as willful defaulter only if the money is more than rupees 25 lakh. And large defaulter, there is category of large defaulter under the willful defaulter, which is if the amount of default is more than rupees 1 crore. If from 25 lakh to 1 crore, I will be classified as willful defaulter. I am a normal willful defaulter. Less than 25 lakh, I cannot be classified as willful defaulter. If it is more than 1 crore rupees, then I can be classified as large defaulter. Now, which are the organizations on which it is applicable? It is applicable to all the regulated entities by the Reserve Bank of India. All the entities which are regulated by Reserve Bank of India will, all those entities, the willful defaulters, the new RBI's direction on the willful defaulters are applicable. So, what are those? Banks are there, NBFCs are there, cooperative banks are there, regional rural banks, for example, they come under the NABARD regulation, but RBI also can, gives direction to them. So, regional rural banks have dual regulatory. Then there are local area banks, all India financial institutions, including NABARD, SIDBI, Exim Bank, National Housing Bank, NABFID. So almost all the financial organizations come under, the criteria. The RBI's directive on willful defaulter is applicable to all these organizations. Now, review and finalization of willful defaulters. Now, within 6 months of being classified as NPA, every organization, each one of these organizations has to classify, and within 6 months of classifying a particular defaulter as NPA, if a bank has said that this asset has become a non-performing assets, then within the 6 months of it becoming non-performing assets, then banks have to review whether this person is not paying willfully or this person has certain financial constraints. If that person has for certain financial constraints, then the bank will not classify that person as willful defaulter. But if that person has remained in non-performing assets for more than 6 months and is not paying willfully, then the bank can classify that person as willful defaulters, and no additional credit to willful defaulter till 1 year after the removal from willful defaulter list. For example, I have been classified by Reserve Bank of ICICI Bank as a willful defaulter. Then even after I have repaid all my money and the ICICI Bank has removed me from willful defaulter list, then also after removal of myself from the willful defaulter list, for the next 1 year, no bank or no financial organizations can give me any loan. Okay, so this is to ensure that they do not tweak the rules and repay money just to take more loan back from the public sector banks. Now, next thing in news is tokenization. Tokenization is basically a process used to replace card details by a unique token or code. Now, tokenization is basically I have a credit card, and whenever I transact through my credit card, the details of my credit card go through that machines to the systems of that organizations to the financial institutions, and those details can be leaked anywhere. For example, I am using a credit card. There can be a camera which captures the numbers of my credit card, so that can compromise my financial the information. So to remove all these problems, the RBI has come up with tokenization of card. So what tokenization is basically done is it replaces the card with a particular unique token or code. Now there will be a alphanumerical code. There will be a alphanumerical code which will replace my card's actual details, and I will use that code when I am transacting in a particular market. So it is applicable in online purchases. For example, I am paying money in Myntra or on Amazon, and my card details can get leaked. So instead of putting my card details, I can put token details, and neither the organizations who is getting money nor the intermediary will get information about my card details. They will just get my token details without exposing sensitive details like card number, CVV value. These will not be exposed. So how does this actually work is basically the payment. I have this card number, for example, this is the number of my card, and in a secure wallet, the card will be converted into token, and businesses will never see customer credit card number. For example, I am paying money on Big Bazaar or Amazon Pay, and those Amazon or Myntra will never see details of my card details. They will never see my card details. They will only receive certain token. The token will look like something like this. This is an alphanumerical code. They will receive the token, and they will just put that token number into the financial system, and they will get their money. So this gives security to the payer. Now one more thing which was in the news is status holder. So what is a status holder? Status holder is basically Ministry of Commerce and Industry. Ministry of Commerce and Industry has unveiled a system-based automatic status holder certificate under foreign trade policy. So status holders are basically exporters. These are the exporters which receive a certain certificate from the Ministry of Commerce and Industry, and they are classified as status holder when they trade more than a particular benchmark. There is a benchmark. Business leaders who have excelled in international trade. So there are certain traders who have excelled in international trade, and they are classified at Ministry of Commerce and Industry as status holder, and the Ministry of Commerce and Industry has come up with criterias, automatic objective criterias. If you fulfill all those objective criterias, then you can automatically get the status holder certificate. You can get the status holder certificate under foreign trade policy automatically if you meet all those criterias. So what are the privileges of having the status holder? I am an exporter, and if I have the status holder certificate, what are the privileges? So there will be a increase in credibility to the exporters in the global market. So in the global market, people will know that I am a reputed exporter and I have the good business in India, and that is why my orders will I will have better market value in the international market, and at the same time I will get priority custom clearance in the Indian custom clearance. Also I will get priority custom clearance if I have the status holder certificate. Next is net interest margin. Net interest margin was recently in news when it was two times in news. First, when the HDFC Bank shares fell by more than 1 lakh rupees crore, and the other was when in the budget they talked about net interest margin, how the net interest margin is reducing and it is improving the banking health of the country. So what is actually a net interest margin? You should be aware about it. Net interest margin is basically difference in interest charged on loans and interest given to deposit. Now there is a financial intermediary, there is a bank take deposit from the saver. I am a saver, I have my salary coming into my account, so I will keep some money as a saving in the bank account. So the savers will deposit their money in the bank, and bank will give some of that money to someone as a loan. Bank will advance that money as a loan. Now the bank has to pay some interest to the depositor. Bank has to pay some interest to the depositors. So to pay interest to the depositors and to meet its own operation cost, the bank will charge some interest to the borrower also. So what the bank is doing? Bank is taking money from her and giving money to him. Now, if bank is giving 5% interest rate to the depositor, then bank will take 10% from the saver. The borrower. The bank will take 10% from the borrower. Now, the difference between the interest that I am receiving from the borrower and the interest that I am giving to the saver, That is basically net interest margin. If I am charging 10% on the loans that I am giving to the people and I am giving 5% to the deposit holders, then 10 minus 5 is 5%. That is the net interest margin, and that net interest margin should be enough to meet all my operational costs, the cost of financing, and the cost of my profit also. All these things should be included in the net interest margin. One more thing which was in news was liquidity deficit in the banking. Now this is basically, all these slides are related to current affairs, that is why they are not in logical flow. The current affairs information, whatever was important, I have taken those in the slides. So liquidity deficit in banking was in news recently, that the liquidity deficit has reduced. So liquidity, what does liquidity deficit mean? Liquidity deficit means lack of bank's liquid asset compared to short-term funds demand in the economy. Now, at any point of time, the people will have certain amount of money they will demand as for short-term purposes. Now, there is short-term demand for liquidity, but the bank do not have enough money with them to meet the demand of the people. As a result, the short-term interest rate will increase. So, bank's liquid asset is equals to what are the assets which are considered as bank's liquid asset? For example, cash, the cash that the bank has with itself. The government bonds, it is also a liquid asset because bank can sell those bonds anytime it wants. And the reserves that the bank keep with the Reserve Bank of India, those are also included in the bank's liquid assets. Now, if these liquid assets are not enough to meet the short-term funds demand in the economy, then we say that the bank is in liquidity, the banking sector is in liquidity deficit phase. Now, what are the reasons for high liquidity deficit? What are the reasons for high liquidity deficit? One is selling of dollars by the RBI. When the RBI sells dollar, then RBI will receive money. I am selling dollar, then I will receive money, and if I receive money, then the liquidity in the market will reduce. Other is increase in repo rate. If the RBI increases repo rate, then it becomes expensive for the banks to borrow money from the Reserve Bank of India for short-term purposes. And if the banks cannot borrow money for the short-term purposes from Reserve Bank of India, there will be liquidity deficit in the banking sector. Then advance tax payment by the businesses. If the businesses are paying taxes in advance, then the liquidity will reduce. For example, I am running a business and I have a turnover of say 10 lakh rupees and I have to pay GST of about 2 lakh rupees, and I do not pay all the 2 lakh rupees at the end of the year. I will pay 20,000 almost every month, or 15,000 almost every month. So as a result, I am paying payment in the advance. I have to pay it at the end of the year, but I am paying it in advance to ensure that the burden does not fall on the end of the year and the burden is distributed throughout the year. So I pay it in advance, and when I pay it in advance, then that will affect my operational cash requirement. The cash that I have in day-to-day operations, that will be affected, and as a result, there will be liquidity deficit with the corporates. Excessive borrowings by the government. So when the government borrow excessively from the market, it reduces liquidity in the market, and we call it crowding out. We call it crowding out. When the government borrows a lot of money from the market, then the corporates do not have enough money, or there is less liquidity in the market to give money to the corporates for short term or the long term also. There can be increase in demand of credit also. For example, in festival seasons, there is increase in demand of credit, for short-term credit especially, and as a result, there can be liquidity deficit in the economy. Now, there are certain policy changes done by RBI recently, which were in news. First is related to UPI. Unified Payment Interface. So, related to UPI, the information, the policy change was increase in the transaction limit. So, what are the increase in transaction limit done by the Reserve Bank of India? First, for hospital and educational institutions, if I am paying money into any hospital or educational institution, then the maximum transaction amount can be rupees 5 lakh. Earlier it was rupees 1 lakh only, but it has now been increased to rupees 5 lakh. If I am paying fee in an educational institution, or I am paying hospital charges, then up to 5 lakh rupees I can do that through my UPI account. Earlier it was rupees 1 lakh rupees only, and now it is 5 lakh rupees. And for capital market, insurance, etc., for example, I am purchasing shares or etc., things like that, or purchasing insurance, then the transaction limit is rupees 2 lakh, and for all other transactions the limit is still 1 lakh rupees. So UPI's general limit is 1 lakh rupees. For example, I am going to market or buy something, do my shopping, then the limit is 1 lakh rupees. I can pay by UPI only 1 lakh rupees, up to 1 lakh rupees only. And if I am going to buy certain securities or insurance, then the limits increases to 2 lakh rupees. And if I am paying any educational institutions fee or hospital charges, then the limit is increased to 5 lakh rupees. So these are the changes made by RBI with related to UPI, increase in transaction. Then there is developed UPI is basically developed by NPCI. This is a static information that which of the organizations developed UPI. UPI has been in news recently. So NPCI developed UPI, and it uses two-factor authentication. Now there was a question upon Bhim UPI. Bhim UPI uses three-factor authentication. Bhim UPI uses three-factor authentication. It was there in the 2018 prelims that how many factor authentication Bhim UPI uses. It uses three-factor authentication, but UPI in general uses two-factor authentication. Bhim UPI is an app. Bhim UPI is an application. UPI is a platform. So Bhim UPI is different. UPI is different. You can use UPI without ever installing Bhim UPI. You can use Google Pay. You can use Phone Pay. So all these apps use two-factor authentication. So UPI requires only two-factor authentication. But Bhim UPI, it's a NPCI app. It's a different app to use UPI platform. And Bhim UPI uses three-factor authentication, which was there in 2018 prelims. Now, the 40% of India's digital transactions are currently being done by UPI. 40% of India's digital transactions are now being done by UPI, and Bhim UPI QR has gained access in Singapore, UAE, Mauritius, and Nepal. So this was extra information related to UPI. Then there are certain other challenges also done by RBI. One is regulatory framework for WALP. What is WALP? WALP is basically web aggregation of loan products. Web aggregation of loan products. Now currently, if I need loan, I go to different banks. I will go to ICICI Bank. I will go to IDBI, or I will go to SBI Bank, and I will ask for if I have to purchase a vehicle, then I will ask for the rates of the vehicle loan on all these banks, and I will compare this. Now what happens is there is certain problems with this process. Problem is that I cannot go to all the banks. I will go to 3 or maximum 4 banks, and then I will choose the best out of them. Now what the WALP do is, WALP will they will aggregate all the loan products on a particular platform. It is basically a platform, and on that platform they will aggregate all the loan products that are there in the market, and they will give as a list in the single page. Now when they do that, you can easily compare all the loan products and you can choose the best out of them. So loans from multiple lenders are listed on single platform. So new regulatory framework for WALP have been issued by the Reserve Bank of India, and borrower can compare and choose from those different lenders. So this was all related to the banking sector. I hope you learned something new today. We'll meet in the next class. Thank you very much.